Hi friends, Simit here from InformedTrades.com. In today's video we're going to talk about the price to net working capital ratio, what that indicator is and how investors can use it to find stocks that are undervalued. So let's get started. Okay, key points. We'll start by defining price over net working capital, NNWC. Some thoughts on using it, pros and cons, how traders use it, how investors have historically used it. We'll look at a sample backtest of how the indicator has performed. And then as well, we'll apply what we've discussed so far to a sample usage with a screener, where we can screen based on price to net working capital to identify stocks that may be undervalued and may be worth buying. Okay, so what is price to net working capital, NNWC? First, we take the market capitalization of the company, which is basically the number of outstanding common shares times the share price, basically what it would cost to buy up every outstanding share, divided by the sum of cash, short-term investments, 0.75 times or 75% of the value of accounts receivables, money that customers owe you, 50% of the value of your inventory, minus your liabilities. So this is very similar to the price-book ratio. Basically what you're looking to, it's a more conservative way in a lot of ways. It's more conservative than the price-book ratio. Basically what you're saying is, if I got the company and I liquidated everything to cash, how much cash would I get? And then you compare that number to how much you'd have to pay to buy all the shares. So part of what makes this even more conservative is 75% of accounts receivables. You're assuming that in this scenario, you wouldn't be able to collect all the accounts receivables. Some customers wouldn't pay or what have you, or it costs you some money to get it. So 75% of accounts receivables, same concept with inventory. 50% of the value of inventory, because if you sold it, you may be forced to liquidate it. So really, cash is cash. You can accept 100% of that. Same with short-term investments. 75% of accounts receivables, 50% of outstanding inventory, or the value of your inventory, minus all your liabilities. So it's sort of like if I bought the company and sold everything as quickly as I could, how much cash would I get? And then market capitalization is the numerator. How much is it going to cost you to buy the company? So it's very similar to, like I mentioned, it's very similar to price book. This is even more conservative to price book. Guidelines. Okay, so this indicator, one, is really useful after a crash. You can get, when there's panic selling, a lot of companies may sell below their net working capital. So, the idea is after a crash, you're going to see more companies that have a price to net working capital of under 1, which means you could buy up all the shares, sell the assets, and you're going to have more money. You don't even have to really do anything. So that the general idea here is that this is an indicator when price to net working capital is below 1, you're finding stocks that are really undervalued. Now, it's not always the case. In some instances, the inventory may be overinflated, so you're just not able to move that. Even though we discounted by 50%, sometimes that may not be enough. Same with accounts receivables. Sometimes you may think we're estimating here that you're going to be able to collect 75% of it. In reality, in some scenarios, you may not be able to. So this indicator, like any other indicator, is not 100% valid. And there's still going to be scenarios where it's not bulletproof. It is useful in screening for penny stocks, and in a lot of ways, or in some ways, you may find that many of the stocks that are trading at a price to net working capital of under 1 have a market capitalization of $200 million or less, and their share price is under $5. So those are two basic guidelines for what a penny stock really is. These stocks, one, when there's panic selling, investors may liquidate them because they're the most risky, the most speculative. So it's like, let me just sell them. They're the most, because they're so volatile, they're also conducive towards a lot of emotions. So it's more likely that you'll get panic selling in them. And there's also a lot of, they're undercovered, meaning these small stocks are not studied as much. So the market is, in many ways, more likely to misprice them. You may find a genuine good value opportunity in this small market cap range. And that's sort of what this article on Fool.com that we're looking at talks about. One, they say the price to net working capital ratio is a great tool for finding deeply undervalued penny stocks. Some of the best microcap candidates, that's how they say. But they qualify it for further investigation. So just because a stock is under 200 million market cap and has a price to net working capital ratio of under 1 does not mean you should immediately buy it. In fact, they say that here. Caveat emptor, reigns supreme in the style of investing. Microcap stocks definitely are something that requires quite a bit of study and expertise. So it's if you have a lot of capital that you don't want to risk, definitely I think investing in bigger companies, large market caps, is the way to go. This is really for someone who wants to focus. You can get outstanding returns, far superior returns than you can in almost any other place, but you really have to be disciplined and you have to know risk management. You have to study a lot. Microcaps are the jungle of the investment world. I think that's pretty, and you will run into this paragraph right here, is very true. You'll run into fraudulent pyramid schemes. A lot of these small companies are scams. Who knows what's going on. But you can find, with that said, you can find some incredible opportunities, and price to net working capital is one way to sort of narrow the field and find what stocks may warrant further investigation. Here are some additional guidelines. This article is pretty good. We'll have a link to it below the video and on InformedTrades.com. But you can also add in some other attributes to help you find it. So, for instance, price to net working capital is under 1. Are the executives buying shares, right? The people that are actually running the company, or do they have faith in it? Are they buying the shares? Is the company itself buying its own shares? Does it have sales? Does it have profits? Do you actually understand the business? Those are things you may want to consider if you do delve into using price to net working capital to find those penny stocks. Okay. Now, something to look at here. Here's backtesting, price to net working capital. There's also something called net current asset value, and that's basically current assets minus current liabilities. It's very similar to net working capital. We won't go too much into that, but you'll see that somewhere and mentioned in some screeners and some charts here. It's plotted on this chart here. It's the purple line here and the blue line on this one. But the green line here and the green line here is stocks based on, or a portfolio of stocks based on price to net working capital. In both instances, they took the 15 stocks with the lowest price to net working capital that had a net working capital of under 1. The portfolio, they also had a daily trading volume of at least 30,000 shares, and they rebalance this every 6 months. So they'd pick the best 15 stocks with a net working capital under 1, the lowest 15, that also had a trading volume of at least 30,000 shares per day, and they rebalance that every 6 months. So you're holding on to these stocks for 6 months, and it was over a 3-year period of time, from 2004 to 2007. And then in this chart, 2007 to 2009. And you can see how it performed. The S&P 500 is the orange line here, and price to net working capital is this green line here. So you can see the stock has done really, really well. Relative to a lot of other back tests, it's done better than many other back tests that I've seen. So I think that's pretty impressive. Of course, it doesn't factor in transaction costs, and we are looking at 2-3-year periods. So past performance isn't always predictive of future value. But I think intuitively, price to net working capital makes a lot of sense. It's a way to buy a company that's really undervalued, selling basically below its working cost. So in theory, you could buy it, sell everything, and turn a profit. That's sort of the idea behind it. And those stocks, they've revealed that the stock's really deeply undervalued, and it's probably going to correct itself in some time. There aren't many of these stocks, so this is a portfolio of only 15 stocks here. So you do have to watch out for it. 2008 was a great time. You see what happens when there's a market crash. If you load up here, this is actually going back to 2007, but if you entered here after the crash, you're looking at a 6-fold gain, 7-fold gain in less than a year, really. So that's pretty remarkable, and sort of illustrates the best elements of the price to net working capital scenario. Okay, now applying this concept to a screener, GuruFocus.com has, I think if you're interested in price to net working capital, this is really one of the best screeners out there, the best one that I've seen, honestly. Price to net working capital is a concept that was popularized by Benjamin Graham. Here you can see him on the screen here. They have a default screener for you, Benjamin Graham's net working capital screener. So here are some stocks, and they incorporate net current asset value, price to net current asset value, which is very similar to what we talked about. Basically, net current asset value is current assets minus current liabilities, and then putting price on top of that. So you're saying what some Graham screens utilize is you want net current asset value to be 2/3 or less of the value of price. So these are deeply undervalued stocks. You can also sort by price to net working capital and find some interesting opportunities here. But what's also interesting is if you go to the screener, the all-in-one screener, and in the valuation ratio section, you can sort of specify price to net working capital. Let me see the ones that are at 1 at most. Right, and then you can also add in other attributes. Right, so you want to make sure the company has at least some revenue. Right, so let's say it has at least $5 million in revenue, for instance. So company has some sales, maybe it has some earnings. Here you can sort of then apply whatever filters you want, and you sort of get something to start with. And then you can sort of filter from there. If you focus on some industries, a lot of microcap investors do, this can be another tool. You can select your industry here to find stocks within a specific industry that you think is going to appreciate in value, find some undervalued microcap stocks to invest in using the screener. And that's about it. Any questions you have on the price to net working capital ratio, anything you want to add, join us at InformedTrades.com. Best of luck in your trading and investing, and we'll see you next time. Take care.